Hello traders, welcome back to another video on our channel. In this video, we will explore the method of drawing supply and demand zones and how to trade using these zones. These supply and demand zones play an essential role in identifying possible market reversals. They help us determine where price movements could rise or fall in the market. The idea of supply and demand zones is a powerful approach for spotting market turning points. These zones tend to perform better than standard support and resistance levels. So, without further delay, make sure to watch the video with focused attention. If you find the video useful, please show your support by giving it a thumbs up, or feel free to share your opinions and feedback in the comments section. I'll see you right after the intro and disclaimer. Here's your rephrased version with the same structure, word count, technical terms, and punctuation. Now, let's examine the concept of demand and supply zones. The theory behind demand and supply zones extends slightly beyond the fundamentals of support and resistance levels. Looking at the chart, this is our support level, where the price has previously moved upward. We have placed a support level here, expecting that when the price approaches this point again, it will rise from here. Let's see what happens next. However, if the price climbs before reaching this level, then in this case, we observe that the price might head toward this point, and we would plan to buy. But if the price increases even before getting here, what should be our approach? In such cases, we have a solution. We can identify its demand zone. If we examine it, this is our demand zone, highlighted in green. Notice how the price entered our demand zone and moved upward instead of reaching the support. Therefore, by learning how to draw the demand zone, we can anticipate where the market could move upward. I will demonstrate how to draw the demand zone in this video, but before that, let's go over a few key points. The next topic is the supply zone. So, what exactly is a supply zone? Here, on this chart, we have an initial resistance level, and we expect the price to approach this level again and reverse from there. However, when the price rose again, it reversed before reaching this point. The price reversal took place from this supply zone, the red-colored box, which indicates our supply zone and caused the price to drop from here. This gives us an excellent opportunity to make better trades by identifying demand and supply zones based on support and resistance levels. That said, this does not mean the resistance level is useless, as support and resistance levels still have their own advantages. Now, let's move on to understanding how we draw demand and supply zones. If you observe this chart, this is our support level. But, if we watch the price closely, you can see it reversed from this point earlier. So, how do we know which level is the demand zone? It's actually not complicated. Marking demand and supply zones is quite simple. Let's break down how. We created the support level based on that candle, and from the candle's body size, we drew a demand zone like this. Notice that the demand zone is equal in size to the candle's body. As a result, the price moved upward again. This highlights the importance of understanding that price can react before reaching the support level. Because support and resistance levels are not precise lines, they represent zones. Shifts in market sentiment often begin before price reaches those support or resistance points. This is why marking demand and supply zones can yield more accurate results. In the same way, we can draw the supply zone. Here, you can see our resistance level. Now, observe this. The candle's wick is very long. In cases where the wick length is significantly larger, we will disregard the wick. Between the open and close prices, we can draw the supply zone like this. The reason is that it aligns with our resistance level. At this resistance candle, we mark the supply zone at its base. You can see that when the price moved up into this supply zone, it dropped afterward. There is no strict rule for the exact size of demand and supply zones. In general, I prefer the zone size to match the candle's range, but if it's excessively long, we omit the wick. Now, let's proceed to the second method of drawing demand and supply zones. The next concept is consolidation. As you can see, the price is moving within a narrow range. From this consolidation, we can draw a zone like this and then observe what occurs next. If the price rises and reverses from this zone, we can form demand and supply zones based on this tight consolidation. Let's consider another example. Here, you can see the market consolidating within a narrow range. Using this range, we have drawn a demand zone. Following that, the price moves downward and then reverses from this demand zone. There is an important point to remember. If any demand or supply zone is tested more than twice, meaning the price has touched that zone over 2 times, the demand or supply zone tends to weaken. This suggests a higher probability that the zone may break. Now that we've covered how to draw demand and supply zones, let's move on to discussing how to trade. Keep in mind that we cannot depend solely on demand and supply zones. We need confirmation from other techniques, such as multiple time frame analysis. This approach involves spotting demand and supply zones on higher time frames and then executing trades based on rejections and patterns on smaller time frames. In addition, we can make use of technical indicators. In this video, we will examine how to combine candlestick patterns with demand and supply zones, focusing on pin bars, doji, and engulfing patterns. When the price nears the demand level, we can notice a loss of momentum. This indicates that as the price approaches the demand level, the average candle size decreases. Eventually, candles such as doji or pin bars begin to appear. This acts as a stronger signal that the price could move upward from this area. We will enter the trade once the high of the doji or pin bar is broken, confirmed by a solid green candle. Similarly, when the price moves toward the supply zone and we observe a loss of momentum, we eventually see doji or bearish pin bar candles form. We will enter the trade once the low of these candles is broken, confirmed by a strong red candle. Let's look at some examples. Here, we have a demand zone because the price rejected this area and moved upward. Based on this candle, we identified a demand zone here. Later, when the price returned to this level, notice how the candle size became smaller. This indicates a loss of momentum. After that, a bullish pin bar formed. At this point, we wait to see if a strong green candle breaks the high of this bullish pin bar and closes above it. If so, we can enter a long trade here. In the same way, we can trade using bullish and bearish candlestick patterns when working with demand and supply zones. I'll dive deeper into this in an upcoming video, so be sure to like and subscribe so you don't miss.